Hi everyone, welcome to the session. In today's session, I'm going to discuss about IAS 23 borrowing cost. Under this, I'll be discussing about some of the main points in relation to borrowing cost. Okay, so let's look at what borrowing costs are eligible for capitalization. Okay, so what sort of borrowing costs you can capitalize when it comes to IAS 23. So under this, there are two main points. Okay, so under this, I'll be discussing two major things. The first one is, can investment income earned on borrowed funds be deducted from the borrowing cost? Okay, so when you have borrowed funds, and those borrowed funds will be utilized in stages. Okay, so it's based on the construction progress. Then if the full amount is not utilized, until it is utilized, those funds can be invested in fixed deposits or other investment opportunities. So suppose if you earn certain income on those investments, what has to be done? So can those investment income be deducted from the borrowing cost? The borrowing cost means the interest cost, okay, that you are paying on your borrowed funds, interest cost. And here the investment income means the borrowed funds invested on fixed deposits or other opportunities, investment opportunities. Okay, so when you earn such income, can those be deducted from the borrowing cost? So this is the first thing that we need to look into. Okay, the second one, second aspect that I'm going to discuss in this session is entity borrows funds generally. This is very important, not for the purpose of obtaining a qualifying asset. I will explain you what is a qualifying asset. Okay, but uses those funds to obtain qualifying assets. Okay, what does it say? Entity borrows funds generally. Okay, so you may be having some other requirements to meet your working capital requirements, to pay your expenses, these kind of things. Okay, not for the purpose of obtaining a qualifying asset, but uses. So these general funds are also used to obtain qualifying assets. So what is a qualifying asset? Okay, qualifying assets means an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. Okay, example, let's say inventories, you are manufacturing a plants, power generation facilities, it takes a considerable period of time, maybe 2 to 3 years. Intangible assets, investment properties, plants. Okay, in those situations, okay, it takes a considerable period of time to complete the construction or complete the production. Okay, in such situation, whatever the borrowing cost obtained for the purpose of constructing a plant, to construct the power generation facilities, okay, can be capitalized. Okay, now let's look at, with regard to these two points, the relevant section in the standard IAS 23. Okay, so let's move on to the standard. I have selected these 2 points, point number 13 and point number 14. Okay, point number 13 says the financing arrangement for qualifying asset may result in an entity obtaining borrowed funds and incurring associated borrowing cost before some or all of the funds are used for expenditures on the qualifying assets. Okay, so this means it takes considerable period of time to complete the construction of the qualifying asset. So therefore, in such circumstances, the funds are often temporarily invested pending their expenditure on the qualifying asset. Okay, so these funds can be invested temporarily. In determining the amount of borrowing cost eligible for capitalization during a period, any investment income earned on such funds is deducted from borrowing cost incurred. Okay, so therefore, what it states is whatever the temporary investment income earned on the borrowed funds should be deducted from the interest cost or the borrowing cost. Okay, so this is the standard IAS 23 states. The second point, to the extent that an entity borrows funds generally, okay, and uses them for the purpose of obtaining a qualifying assets, the entity shall determine the amount of borrowing cost eligible for capitalization by applying a capitalization rate to the expenditure on that asset. Okay, the capitalization rate shall be the weighted average of the borrowing cost applicable to all borrowings of the entity that are outstanding during the period. However, an entity shall exclude from this calculation borrowing cost applicable to borrowings made specifically for the purpose of obtaining qualifying asset until substantially all the activities necessary to prepare that asset for its intended use or sale are complete. The amount of borrowing cost that an entity capitalizes during a period shall not exceed the amount of borrowing cost it incurred during that period. Okay, so as I explained you in the previous point, okay, if funds are obtained for general purpose, okay, to operate the business, to meet working capital requirements, okay, so if those funds are used for the purpose of obtaining qualifying asset, then how do you capitalize that cost? Okay, so in order to capitalize, we need to identify a capitalization rate. Okay, capitalization rate. So that should be the weighted average of the borrowing cost applicable to all borrowing of the entity. Okay, so here all borrowings means general borrowings, not the funds which are borrowed specifically for the purpose of the qualifying asset. So that you can exclude. If general funds are used for the purpose of qualifying asset, then you need to identify a capitalization rate. Okay, so let's move on to this particular question. Okay, let's go through the question. AG PLC commenced the construction of power generation plant on 1st January 2020 and completed the project on 31st December 2020. So here it took 12 months. Okay, the funds required for construction were mainly obtained through bank loans. Following are the details of such bank loans. Rupees 6 million, this loan was received on 1st January 2020 and repaid on 1st January 2021. The entire proceeds of the loan were utilized for the plant and the interest rate is 15% per annum. Okay, 6 million worth of loan was obtained to manufacture, to construct a power generation plant. Okay, and the interest rate was 15% per annum. AG paid 1 million on the contractor to the contractor at the commencement of the contract, and the balance was paid once construction was fully completed on 31st December 2020. AG earned 500,000 rupees by investing the balance of loan proceeds 5 million during the construction period. Okay, so now what you have to do is you need to identify how much of the borrowing cost that can be capitalized. Okay, so now here the 6 million was obtained on 1st January 2020 and it was repaid on 1st January 2021. So therefore, this 6 million times what is the interest rate? 15%. 15%. Okay, for 12 months period. So how much that will be? 6 million times 15% will be 900,000. Okay, this is 900,000 for this 12 months period. Okay, now out of this, okay, they paid 1 million to the contractor and the remaining 5 million was invested and they earned 500,000 because the remaining balance was paid when the construction was fully completed on 31st December 2020. So therefore, this 5 million was deposited and they have earned 500,000 for 12 months period. So therefore, this 500,000 can be deducted from this. This is the borrowing cost. Okay, this is the borrowing cost. And from this, you can deduct whatever the investment earned on these funds, which is 500,000. So therefore, you have to capitalize 400,000 as borrowing cost. Okay, so this is the answer for the first part. The second part, AG has the following loans which were borrowed not specifically for the construction of the power plant. As I explained you, these are general funds which are not borrowed specifically for the construction. Okay, this is for the other operational activities. 2 million worth of loan was obtained at the interest rate of 15% per annum. 3 million interest rate 14% per annum. Both these loans were obtained on 1st January 2020, so which is the beginning of the construction. Had been outstanding during the year ended 31st December 2020. AG used 2.5 million out of these funds of these two loans for plant construction on 1st July 2020. Okay, so which means these loans were obtained on 1st January, but it was utilized after 6 months, and the construction completed on 31st December 2020. So therefore, this 2.5 million was utilized for this 6 months period. Okay, from July 2020 to 31st December 2020. So out of this 2.5 million, how much to be capitalized? Okay, so here in this situation, you need to identify, since you are given two loans and two different interest rates, you need to identify weighted average cost of interest. That weighted average cost of interest should be applied on this 2.5 million for 6 months period. Okay, so that's how we had to calculate the what you call the borrowing cost. So here we have to identify the capitalization rate. Okay, so let's calculate. Now we have 2 million at the rate of 15%. What will be the interest cost? So 2 million times 15%, 300,000, which is 300,000. Then 3 million times 14%, which is going to be how much? 14%, 420,000. Okay, so total is 720,000 for 5 million worth of loan. Okay, here there are two different interest rates. Okay, so therefore, what is the weighted average cost of interest? How do you calculate? So interest amount 720 million divided by 5 million times 100. So when you calculate that, you will get an interest rate of 14.4%. This is a weighted average cost. Now, this rate, this is the capitalization rate, should be applied on 2.5 because out of this 5 million, they have used 2.5 million for the construction purpose, okay, for the qualifying asset. These are general loans obtained for the business. So therefore, 2.5 million times 14.4% times, this is utilized only for 6 months period. So therefore, you can take 6 over 12. So that comes to 180,000. Okay. So therefore, the total borrowing cost to be capitalized, total borrowing cost to be capitalized for the period is, okay, 400,000 plus, these are 400,000 plus 180,000. So that comes to 580,000. Okay, so this is the answer for this particular question in relation to IAS 23. So I have discussed two major points. One is, can investment income earned on borrowed funds be deducted from the borrowing cost? Yes, you can deduct it. Entity borrows funds generally not for the purpose of obtaining a qualifying asset, but uses those funds to obtain qualifying assets. So in that case, what you need to do is you need to apply a capitalization rate, as I explained here. You need to apply a capitalization rate, which is nothing but the weighted average of the borrowing cost. So this is how we calculated in this particular question. Okay, so that's all for today. And thanks for watching, and I will see you soon with another video. Until then, bye for now.